bullish story starts in 2026. I think we're looking in Q4 for US dollar, $80 for WTI, and then stronger prices in the outlier years. You get to $150, $160 WTI, I'm willing to bet that any company that's still public at that point will be trading at 5-10 times what it is today. Right now, I don't think there's enough uranium being produced to meet the current demand. So if SMRs take off, that just is a driver that really is going to push the need much, much higher. We know we need more oil, so prices have to go high enough for the companies to have the cash flows to reinvest, to bring on those, and that's why you get the big upside, just like we're seeing with the precious metals.
Josef Schachter, author and president of the Schachter Energy Report. It is a true pleasure to host you on Palisades Gold Radio today.
Very glad to be with you, Stan, my first time, and I'm looking forward to this. I don't cover gold, but I cover the energy space, so this is a new one for me, and I'm looking forward to it.
Definitely excited to pick your brain on energy. I mean, it's an exciting time to talk to you. Currently, WTI as a proxy for the energy complex is currently trading at about $60 a barrel. Seems to be repressed. From your perspective, in November 2025, how should one view the energy complex currently?
Well, crude oil right now is got two drivers. You've got the pull from the point of higher prices based on Russia potentially not being able to sell oil, and that the American government has put in some additional sanctions on Rosneft and Lukoil so that they can't sell, and that anybody who's a buyer of their oil will see secondary sanctions. So that's the part that pushes prices higher. At the same time, on the downside pressure, you have significant inventories in the United States and in Europe and in Asia, and we have a lot of floating storage, billion barrels in floating storage. So there is right now a near-term excess supply, but our view is that the price of oil might go down between now and the end of the year, sometime maybe early or mid-December, to $56 to $58 range per WTI, and we're 60, so we're not that far away. And we can have those kind of $5 moves very easily if we get some big inventory builds on a couple weekly basis from the EIA, the Energy Information Administration of the U.S. government. So that plus concern about these excess inventories, I think, takes us lower. Heading into 2026, I think we're going to see demand growth of 1 to 1.3 million barrels. So the key is, where's the new production going to come from? So you will have more production from Guyana, you'll have more from Brazil, a little more from Canada, and then we'll grow and eat into inventories. Where the bullish argument is, and which doesn't get a lot of attention, is the fact that global reserves decline in the United States, in the big plays like the Permian and Canada, the Montney, decline rates are 40 or 50%. But in other places like in Saudi Arabia, it may only be 1 or 2%. So the overall global number seems to be 5 to 6%. So if we have 105 million barrels, that means we've got to come up with 5.5, 6 million barrels of new production every year just to stand still. And we're not spending enough money right now. There's lots of sources telling you just even to replace declines. So that to me is why the bullish story starts in 2026. I think we'll see Q2, let's say US $70 a barrel, so versus 60 today. And I think we're looking in Q4 for US dollar, $80 for WTI, and then stronger prices in the outlier years. I think before the end of the cycle, and we can talk about super cycles in energy as we go along, I think the high of 2008 in the summer, when we got to US 147 per barrel, I think we will exceed that before this end of this cycle. Just like we're, seeing the move in gold. Was it 800, then 2,000, then 3,000, then 4,000, then 4,400? I think, people don't realize how high can be to replace the declines and to provide sufficient new reserves. And if there's an eagerness to own the product, and in this case, it's not just, for the issue of, concern about currencies or government debt or whatever. Gold physical capacity is not enough to meet physical demand. That was the point, the pinch point that took it off. I think we will see that pinch point come sometime late 26, early 27, and people will realize that the demand for energy is starting to eat significantly into those storage reserves, both commercial and strategic petroleum reserves, the SPRs, and that will get the game going significantly. And I think we've seen many companies trade at 1.5, 2 times cash flow on depressed cash flows now. Historically, at market euphoria periods, let's use that word, they trade at 7 to 8 times peak cash flow. So if the price of oil goes from $60 to $160, and companies add more production, the reserve values are worth more, and the cash flows come up significantly, that's where you're going to see the big upside. And I think in the cycle that there's a lot of 5 to 10 baggers between now and let's say 2030. And so you need to have companies with, good assets, with strong upside from exploration as well as, the development and exploration, have very good management and of course strong balance sheets. So if they have that, you're going to see big home runs. And I think the same logic applies to the gold sector.
What a great summary, Joseph. So many threads to pull there. Incredibly interesting. How about we first start with the underinvestment that you outlined there? Of course, on the short term, you're bearish oil because of an excess supply dynamic. Long term, bullish, incredibly bullish, it sounds like. Part of that equation is that underinvestment that you outlined. Where is that coming from? And what is the order of magnitude of underinvestment that we're talking about?
Well, there's so many stories talking about $5 trillion needs to be spent. So if you take it over, the 5 years, you're talking, you're talking 500 billion a year. We're not spending, 300 billion. So, all around the world, the big Exxons, the Shells, BPs, all the different Total, everybody is, they're all not spending enough to replace declines in there. And then you go to the OPEC countries, only really Saudi Arabia and UAE and Kuwait can increase production because they have free cash flow. And so the key thing is you need to see free funds cash flow. So you need to have cash flow comes in, you have the operating costs, then you have the money to spend to keep production flat. And then free funds flow then brings you the opportunity to put more money in the ground to bring on more production. It allows you to do shareholder returns. And in Canada, the two pressure points becomes normal course issuer bids, stock buybacks by management and approved by the board, and dividends. And in Canada, people like to have both. We just had a Catch the Energy conference here in October at Mount Royal University, and we had 33 companies presenting. And the big story, and one of the things when I did my opening speech, was I asked the question of, from the individuals in the room, how many of you would like the companies to spend all of the free funds flow out in for stock buybacks? How many for dividends only? And how many for both? The majority of the hands went up for both.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades, Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Yeah, what is incredible about these oil producers, of course, that they can do both, oftentimes incredibly high quality companies. But before we talk about that, I would love to continue talking about the demand and supply dynamics for a second. Of course, you outlined that you need free fund flows to actually be able to reinvest them into exploration and then development eventually. However, there's also quite a big lag between that, right? You need to explore, that takes time, developing takes time, then actually going into production takes a bit longer as well. So there's quite a bit lag between recognizing that there's a problem and making the investments and then new supply coming back online.
That's the big key for the industry. It takes, and the big one is infrastructure. So number one, you need to have the land, and you have to have done the geology and geophysics to say, I know, here's where I want to drill, here's the depth I want to drill, here's how I complete the wells fracking, what type of frack and all that stuff. Are you going to go 1 mile or 5 miles, horizontally? That's, all of that stuff is the technology that's really been developed in the last 5 years or so. The big thing, of course, is the facilities. If you don't have pipelines to bring the product to the water, in this case in Canada, we need LNG pipelines to the West Coast, and then we need LNG facilities. We have LNG Canada up and running, doing about a BCF a day and they can go to 2 BCF with the 2 trains they have now. And they're going to make an FID, final investment decision, to do another 2 trains. And hopefully that happens, in the first quarter, second quarter of 2026. And then that'll be 28, 29 that it comes on. And there's other projects in the hopper too. The big problem is oil. We have the TMX pipeline to go to the West Coast. For many years, people said we should get a pipeline to the East Coast, which of course Quebec and a few other provinces were not in favor of because they want to get away from the fossil fuel industry. So to me, the same thing is applicable in the United States. Same thing is applicable, in Guyana offshore. How do you get the production to market? Brazil offshore, the salt domes and stuff. Everything takes longer than you think. Discoveries in Namibia were made years ago, but they still need more development drilling. Then they need to bring in the FPSOs, and it takes time. So that's why I think prices of oil go higher, simply because of the time lag. And just like that same time lag, you could argue in the precious metals complex. Somebody makes a discovery, has some great numbers, but till they put the mill in, till they do the production, all that takes time. Environmental approvals, First Nations approvals, everything takes longer now than it might have in a place where there wasn't all of these you got to check every box. And that to me is really the key to enhance the length of this cycle, simply because after you make a discovery, you don't think it's not coming on in a year like it may have in the past. It may be 3 to 5 years. And the biggest part is the takeaway side. How do you get it to market?
Understood. So because of those time lags in between making a discovery, making the investments in the infrastructure, and actually getting the production going, we might not be talking about the flash in the pan here that you see in so many smaller commodities, but we might be talking about a sustained, longer-term type of super cycle, like you described it earlier.
That's correct. Cycles in energy are long, but then, like any industry, we go from undercapacity to overcapacity. So right now we're still trying to, get inventories in balance. But as demand grows in the next year or two, that'll get to that pinch point. And then, we know we need more oil. So prices have to go high enough for the companies to have the cash flows to reinvest, to bring on those. And that's why you get the big upside. Just like we're seeing with the precious metals. When gold took off and got over 2,000, cash flows really started ramping up. The industry could spend money on exploration. They could buy out other projects. And so the same thing will happen in energy. And it's happened before. In my career, I've had 2 prior super cycles, 1974 to 1981. In 74, the price of oil was around $2.50, and we came out of the recession of 72, 74, and Japan became the exporter to the world. We started buying Panasonics and Datsuns and Toyotas, and so for them to create those products, they needed to consume more energy. That became the pinch point driver of the higher prices. And before it was over, the price of oil went to 36. We had the price of oil went up 12 times, and the price in the oil and gas indexes went up 15 times. So from 74 to 81, 15 times. That's a hell of a score, and very good for investors. Then we went into a trading period because it was too much capacity and demand was sluggish, and we had recessions and all that stuff. In 1999, the next cycle started, and China became the driver. And China was consuming about 3.5 million and producing about 4 million barrels a day. And China said, okay, we're going to allow capitalism under communist umbrella. And so all of a sudden, the capitalist drive just happened, the export market happened, the Walmart effect that we talk about. And so demand went up into the 15 to 17 million barrels a day range. And that drove the price of oil to 147 in summer of 2008. So we had a massive run from 1060 something, 1068 or so to 147 plus. That became, many stocks were 10 baggers during that cycle as well. And then the problem was, of course, the financial crisis of 08, 09, demand fell. Everybody had to cut back production. And so we're bringing that production back on, as we've seen with all the OPEC announcements. And right now, we're looking at global demand about 105 million barrels. And putting that in context, Saudi Arabia's 9.7. If you put into account all of OPEC, it's 27.9 from the data just in front of me right now. And of that 9.7 is Saudi Arabia. You put also, where's Russia? 9.2 million barrels. But here's really the thing that people don't realize. U.S. Crude production is 13.6 million, and then renewables and natural gas liquids are another 10. So the U.S. produces 23.6 million barrels. They consumed last week 21.3. So that's why they have, they not only can they meet their own demand, but they can also sell and export oil, and they do. Over 3 million barrels a day are exported, and it's the light crudes coming out of the Permian and the Eagle Ford that can't be processed in the refineries on the Gulf Coast. And what they do is they import heavies from Mexico, mostly from Canada. Canada produces 3.58 million, so 62% of U.S. imports comes from Canada, and it's the heavy crudes coming from our oil sands, from our SAGD projects. And Canada, some people say it's the third largest reserves for oil and natural gas in the world. Venezuela might be number one, Saudi Arabia number two, and we're way ahead of Russia. In terms of, just putting the pecking order, people don't realize is United States, as I mentioned, 23.6, 9.7 for Saudi Arabia, 9.2 for Russia. Canada produces 6.2, and the next one below us is 4.3 is China. So we really stand out there. And the question is, do you want to deal with Russia? Do you want to deal with Saudi Arabia? Or do you want security of supply? And so really Canada's in an advantageous position if we have the political direction to support the resource industry.
Well understood, and therefore I think you're alluding to that Canada might be an incredibly interesting place to invest in oil developers and producers that are exploring.
Yeah, I think the new Canadian government is reversing the Trudeau policies, and we're going to see today a budget so we can see what the government's going to do in terms of support for growing our pie. And the key thing is I think they realize when you have a $70 billion deficit, you've got to do something to grow the pie so that you can have enough money for government programs, but you also can get the companies and individuals to benefit from the growing of the pie. And so I think they realize they need to support resource development, be it natural gas, be it in the mining sector, be it in technology, so that, rare earths. So all of that is coming together. And I think we're going to see the governments slowly, with First Nations support, with environmental controls being pretty tough, but they'll make sure that, I think they're going to make sure that the opportunity is there to grow the resource base of Canada, be it forest products, which was a big part of Canada, nickel, copper is a big part of Canada, precious metals are. And so we have an opportunity here. Aluminum's been a big part of Canada, steel, is a big industry. So if we can open the door for the industry to see the benefits of adding investment and having the ability to export that and sell in Canada, of course, we have to break down the barriers of interprovincial trade. There's lots of things going on to make it work. But if they do go that way, then you could argue that Canada will be, again, a resource superpower like it's been in the past. And, we have a massive resource base that's still undeveloped. And First Nations are now on side with it because they see, number one, ownership. Number two, massive amount of jobs, high paying jobs, high quality jobs, and they can help to control the fact that where it's developed doesn't go into specific lands that they feel are special, religious wise, and don't want anyone involved in touching that space.
That case is definitely very clear, and of course, it cannot be disputed that Canada is incredibly well endowed. You mentioned earlier, we know we need more oil. I wrote that down because, of course, there's this thesis out there in the world of peak oil. I take it you're not a subscriber to that thesis.
No, I think, nobody believed the United States would be able to grow production. They at one point were an importer of 7 million barrels, but then all of a sudden the fracking came into a case and hard rock could be broken up and get the oil out of it. And now you look at the, the U.S. shale production, it's a big portion of the total, probably more than half. And in Canada, you look at our oil sands and our SAGD, it's more than half. It's probably 2/3 of the total. So new technologies have been made available to unlock the resources that were there. So right now, let's say demand is 105 million barrels a day. My expectation is by 2030, it's going to be 110, 112. And most of that growth will be in the non-OECD. OECD will come down. And then I think if you go to 2035, you could be looking at another 4 or 5 million barrels. So the argument in favor of the industry is there. The question is, where is it going to be produced? Is it going to be produced in the Middle East? Is it going to be produced in Guyana? Is it going to be produced in Russia? Or is it going to be produced in, North America? So, one thing is the North Sea is still, a viable opportunity. And, we know Norway's benefiting from it. There's lots of activity going on in the Netherlands, both for natural gas, especially for natural gas. So, everybody thinks some of these basins are tired, but it's the reality, same thing like gold. Gold had used to find it at, maybe a couple hundred meters down. Now we're going a lot deeper than that, and some of the mines in Africa are, miles down below the surface. So new technologies, deeper, learning how to mine at deeper levels, learning how to crack the rock for SAGD and for oil sands, and then the Montney, Duvernay, Permian, all of that required a lot of new technology, and the industry has found ways to make things done efficiently. Right now, I think the industry needs $60 oil in the United States to justify what they're doing. In Canada, it's a little bit less because we have a Canadian dollar that trades at 71 cents US. So, it's like 1.4 times the price. And so the Canadian industry can do well on liquids at that price. But natural gas is the problem for Canada. We need higher prices domestically. Contracted gas to the Gulf Coast, contracted gas to Dawn, or contracted gas to California. And the LNG now, that's giving us higher pricing. We need to have enough takeaway capacity so that a lot of our natural gas that right now is landlocked, and sometimes dry gas gets shut in when we have very low prices. And sometimes when storage is full, we can have negative prices. So companies have shut in their own production and bought, natural gas at a negative price and then delivered it to their customers and made money on that. There was an article in the Globe and Mail on that today.
That's just an incredible opportunity. Of course, you referenced the shale oil revolution a couple of times in the United States, where they've gone from a net energy importer to a net energy exporter. And with that comes a lot of natural gas production, if I'm not mistaken. Most shale oil producers seem to produce around 50% natural gas. And that's really what's causing these incredibly low, sometimes negative prices, isn't it?
Well, they had sometimes when there wasn't pipelines to take it to the Gulf Coast, they had negative prices in that part of the market. So if it's in New Mexico or the northwest part of the Permian, you might have had a period where pipes had to be put in and taken to the LNG market. But with LNG in the States being, 16, 17 BCF a day now, up from nothing a decade ago, the industry is found a way to move the gas. And a lot of that LNG, production is going to Europe, and the cost of moving it and the price of moving it is higher than the delivery to Asia, simply because the demand in Europe is so strong, because they're trying to displace Russian natural gas. And so they're big buyers of it, and they want to fill up storage sufficiently that if there's a normal winter, they're okay. and also that they can survive with more imports if there's a cold winter. And again, I can't forecast Mother Nature at this point, but we know winter's coming, as you do from Game of Thrones.
Definitely, definitely. I guess this is a great time to start talking about some of these opportunities. Of course, you referenced in Canada that natural gas is oftentimes still going negative, or at least trading at very attractive prices. That, of course, is a situation that will not last forever. Natural gas is energy, oil is energy, and people will find a way to use energy. So what are some interesting ways a potential investor might be able to leverage that opportunity?
So there's different ways to invest when we talk to our clients. And, a lot of people would like to get a dividend that's equal to what they can get in the bank, the 4% kind of thing. So companies that are doing both growth and paying a 4% dividend are very popular in Canada, and those can be royalty entities. It could be E&P companies that are producing both commodities. We have some companies that are yielding 7 and 8% just looking at the data in front of me. So there's some great opportunities there. Some of them have less growth rates because of the higher dividend. Others others are focused on the growth and don't pay a dividend. So you really have different client bases, and so you need to say to them, okay, if you're looking for natural gas with dividend, with growth potential, here's a list of names. If you're looking for the home runs of a small cap that could have massive growth in production, here's another group. The service sector is going to benefit because utilization will go up. So the pricing for drilling rigs, for completion, for fracking, all of that pricing points will go up, and that will create a lot of upside value to investors. We also cover Canadian companies that work internationally. So Canadian companies working in Trinidad, in Colombia, in offshore Thailand. And a lot of them have great upsides with the drill bit over time. But again, you need the right price and you need the facility. So all of that takes time. We look at a lot of companies, and we do in our work where we have a 12-month target. So we give them a recommendation where we say, at this price, it's a good buy. And it might be, right now we might be saying, if I'm right about $56, $57 WTI, we might see a 10% decline in the TSX Energy Index, and that might bring some stocks down between 5 and 20, depending upon the profile of the debt of the balance sheet and the debt on the balance sheet. And then we give them a one-year target. If I'm right about $80 crude in Q4 of 2026, here's where I think the stock could be. And then we talk about the cycle. So 5-8 years down the road, where could the stock trade? And we use it based on the other cycles. Multiple expansion, NAV rises because of the higher commodity price, higher volumes. And so we look at all of those historic valuations, and that's where we get our long-term targets. So, for example, we have one company, let's say Birchcliff, which is a natural gas producer. It's trading under $6. We have it a buy under $6, but we have a $9 one-year target, and we have a $25, bull market peak target. We have some that are even, much more leveraged to the upside. And again, it's just, what's your risk profile? And then, there are names to meet that need. My view is, of course, as I get older, my wife likes dividends. And, so we want to have more of our portfolio providing us with yields. And I'd rather make something more than 4% in the bank. And, I can just give you a few examples. Freehold Royalty, one of those royalty trusts, yields 7.8%, pays 9 cents a month, $1.08. We have Whitecap Resources, which is, paying a 7% dividend yield, 73 cents there. We've got Marin Energy, which is offshore Africa, with a 5 cents a quarter dividend, 10.8% yield. You've got Surge Energy, 7.4%, paying a 5.2%, 52-cent dividend paid monthly. And then Alvo Petro, 8% yield. So there's lots of names. So if people go to our website, they can see some of our historic research. So www.schachterenergyreport.ca. So Schachter is SCHACHTER. They can see the research from the historic. We also do a macro piece called Ion Energy, which people can get on Substack. or if they're a subscriber to the full product, they get that included. So it's we've done, we started this in 2017. We were recommended by a friend of mine in Vancouver who runs a annual conference, and Michael Campbell suggested, Joseph, analysts were being fired because the sector was in disarray and nobody was making money, no underwriting. So that cycle where gold analysts were let go 3-4 years ago. And so he said to me, why don't you create a subscriber product for companies? And we were looking at starting out with 20 companies. And from February to April, we got it launched, covered 20 companies, and then we grew with with more names as time went on, expanded the team here, and so it's worked out very, very well. And so we now cover 32 companies, and we're looking to grow we've had 2 takeovers just this month in October. So you get takeovers all the time, so you need to find some new names that are attractive. Right now, my focus is to go through all of the Q3 results, and then once the Q3 result run is done, I'll start going to see some of these companies that have been on my watch list for a long time, and we'll bring up our number of companies again. And again, we're looking, at the E&P side domestically is really where we see a lot of great opportunities at this point, and those are the names that we'll be bringing on in our service in early 2026.
Really interesting, Joseph. And you outlined something there, 2 engines, you could call it, working for you. Of course, if your NAV goes up, that will help the stock price. Also, if you have a multiple expansion, if you go from a low multiple in the trough of the cycle to a higher multiple in the peak, you could have both those effects working at the same time, and that can result in some incredible results.
Yeah, and I think you can argue that for every resource sector. You plug $800 gold in, it's worth this amount. You plug 2,000, 3,000, the numbers change significantly. And so if you plug in $60 WTI, you'll have a certain NAV, and the reserve engineers will tell you what's the reserves, and then you put in your price for PDP, proved developed producing, and then proved non-producing, and then probable, and then you lower that price. So it might be 14 for PDP, 10 for 1P non-producing, and then 2P would be probably $8. And so that's really how we do the calculations. But if the price deck from the Spruills, the McDaniels, the GLJs goes up with $70, $80, $90, $100 oil or more, then that really with the reserves gives you the reserve calculation. And on the cash flow side, if the price of oil goes up to 70, 80, 90, cash flows will go up and production hopefully will go up. And so then you put a multiple expansion on that. So you got those 2 drivers, 2 levers, and if both are going in the same direction at the same time, that's where you start seeing the torque, where stocks really take off and really you get a lot of reward. So, things don't all go at the same time. We've seen, in the commodity sector, cocoa's gone nuts, copper's done well, gold, of course, has been awesome, silver's been awesome. And, historically, the biggest part of the commodity board is energy. And so my expectation is it's a lagging one this time. Sometimes it's a leading one, but every time it changes. Look at cocoa prices or, and coffee prices, they've gone nuts. But if you look at some of the grain board, you can see things at the low end of the board. So, we're going to see, 2026 be the pinch point year where we go up. I don't think we're going to see peak oil in my lifetime. I think there's always new basins to go after, but the price of each new barrel may be more expensive because you need to bring in new facilities. So you may have to drill further and further offshore. Then you got to put in the facilities and then bringing that to shore to the market. Every new barrel will be more and more expensive, just like every new ounce of gold is going to be more expensive than it was 2 years ago. So the logic that we apply to one commodity is easily applied to the other.
Well understood. And what about some of the opportunities that international companies are showing? For example, you talked about Norway just a few minutes ago. There you have a few companies like DNO ASA or Aker BP that are trading at, close to a 10% dividend yield as well. Is that something that's on your radar?
No, I cover the Canadian companies, that work domestically and internationally. And I want NI 5101, which is the regulatory constraint that they have of reporting the reserves and, how much they have in decommissioning liabilities, how many producing wells versus non-producing. So the framework of our business is that the Canadian rules taken around the world. And so we cover a company like Valeura that's offshore Thailand. We cover Touchstone, which is onshore Trinidad. We cover Gran Tierra, which is onshore Colombia. So we look around the world to find new names. Marin is right now offshore Nigeria, looking to go other places with Namibia, exploration with them. So we try to find companies which fit the our rule-based system, so that we have the data we need to be able to say, okay, here's what the NAV is, here's the discount from that NAV, and here's how that NAV grows. And then we look at the timeline. We think we'll tighten those two up. Is it $70 oil? Is it $90 oil? Is it X amount of production? You need to have all of those and, juggle them and then see how it all comes together. But the big thing is, if we get $80 oil by the end of next year, and we get $100 oil in 28 or so, and higher than that in 29, 30, 31, you get to $150, $160 WTI. I'm willing to bet that any company that's still public at that point will be trading at 5-10 times what it is today. So I think takeovers are going to be a big part of it, because is it cheaper to drill, or is it cheaper to buy them on Bay Street or Wall Street, or I don't know if the Rotterdam has an exchange, or is it the Amsterdam exchange, but you're going to see a lot of companies being taken over, because if you own a piece of a play and the big boys are next door and they love it, they're going to take you out. And we've seen that happen historically in the North Sea. We've seen it happen on the Gulf Coast of the U.S. We've seen it onshore happen. ExxonMobil just bites and, enjoys eating everybody around them if it's the right. And we've seen, CNQ in Canada and Tourmaline be the buyers of many companies. And so they want to control more of each play, because they all see the optimism for much higher prices, and that the demand is coming, and they see the growth from the emerging world driving the need for more energy. And of course, every new barrel will cost more, which means if you have as many barrels as you can captured now, those will be worth more later when you do sell them.
Well understood, and it sounds like an exciting future for anyone that invests in oil and gas, energy in general. I would love to transition to geopolitics for a second. We oftentimes hear that, for example, close to 20% of all oil flows through the Strait of Hormuz. It seems that the energy markets are quite vulnerable, and it seems like this world is trending to a more chaotic place.
Oh, I would agree with you that the Red Sea, the Straits of Hormuz, the Straits of Malacca, to get to Asia. There's lots of places where you can have pinch points, and you can have piracy, and you can have all the ethnic, like the Houthis doing what they were doing in the Red Sea. I think that geopolitics will always be with us. Just remember, just a couple of years ago, the price of crude was trading at in 2021 was trading at $60, and then when after Ukraine got invaded by Russia, 126.42 for WTI. So any geopolitical challenge is going to drive prices even higher. If you go to the 74 to 81 cycle, it was the deposing of the Shah of Iran and the Ayatollahs coming in with the new government, and they shut out production. That was the thing that drove the price from 28 to 36. So you can always see these shocks come in. And you go back to 2008, and we were $80, and then at the beginning of the year we were 147 by the summer. So if you get to the point where the inventories are low, demand is high, no new production can come on, that's when you get those spikes and parabolic moves, in fact. And I think we saw that in gold. Now it's cooling off a little. We've seen that in the AI stocks. They're cooling off a little bit. So I think any sector, any group, any company that has one of these parabolic moves, is going to feel at some point that the valuations get excessive, and something tells people, hey, maybe it's gone too far, and maybe our valuation models are wrong.
Understood. The complex situation that we're seeing in Venezuela, of course, with the US operating in that region. Some people speculate that might be about oil because Venezuela is an oil-rich region. Do you think there's any credence to that argument?
Historically, I think we've seen, Venezuela produce, I think, near 4 million barrels. In the last month production was 936,000, according to the reports just in front of me. So they have the ability to add 2 to 3 million barrels. So historically, those barrels, when it was pre-Chavez, were produced by American companies and was sold and was moved into the refineries on the Gulf Coast. Everyone was nationalized when Chavez and Maduro took over, and only right now Chevron is operating there now. And there's some specifics of how the cash goes to the people and not to the government. So there's some, they've made a deal with the American government support. So they are doing some. But if there's a change in regime, and they give back the assets to the ones that they nationalized, it won't take long for the American companies to come in and bring on more production, over the next 2, 3, 4 years. So at some point, Canada needs to get more export capacity west. I don't think it'll ever be east. And so because we may lose 1 million or 2 million barrels once Venezuela changes regime and brings on more production. And remember, the distances from Venezuela to the U.S. Gulf Coast, compare that to coming from Canada down to the Gulf Coast. There's a transportation advantage, and plus, if you're the owner of the reserves in Venezuela, and the refineries are yours in the Gulf Coast around Houston, all of a sudden the economics make very much more sense than buying it from Canada. So I think Canada is going to have to start figuring out, how do we get another 1 million, 2 million barrels of takeaway capacity on the West Coast? And TMX is talking about putting on more compression, maybe, twinning the pipeline. Maybe we do a second pipeline. Our premier is focused on getting a second pipeline there. And again, if they get the approvals politically, First Nations need to be on side, environmental rules have to be fed, find the right route. And of course, these pipelines just get more and more expensive every time. Every project is much higher than the initial budgets, as we've seen all around the world. The numbers just go higher and higher. And of course, that means you need a higher price to justify spending that money.
Incredibly insightful, Joseph. I would love to play devil's advocate for a second. Is there anything that could derail this longer-term bullish thesis that you have?
Yeah, I think the two parts of it is, if this trade war stays ugly and global trade goes down, and if you remember Smoot-Hartley during the 1920s, early 30s, it turned into a global, not recession, but depression. And so if you drive the global economy into the ground by not solving this trade issue, and right now it's before the Supreme Court to see if the government of the United States has the right to do this. If the deal and the negotiations, continue, or they find another way to do tariffs under other legislation, the Americans can start having their balance of trade swing in their favor more than the massive trade deficits they have now. Get those manufacturing job and high-paying jobs back to America. And technology makes a lot of sense. Why should semiconductor chips be made in South Korea, Japan, and Taiwan, and not in America? And so we're seeing more and more factories being built, fabs as they're calling them. And so I think that we will see the negative side have less and less argument, over time. But if it got into a really nasty trade war with China, and its circle of countries that work with them, not work with the United States and the OECD countries, that could make things worse. And the countries that would probably be the ones to worry about more so than Canada would be Australia and Japan, South Korea, so I think that. I think nobody wants to go to the precipice. I think at some point, hopefully, there is some rational behavior, and that takes away the negative case. But the negative case is global recession.
Well understood on that bear case. With all these geopolitical chaotic events occurring. Do you think there's a chance that we see a bifurcation, a larger differential in price and energy prices than we're currently seeing?
Well, there's a difference between each grade. So the heavier the crude, you have a lower price. Brent trades higher by about $5 versus WTI. So there's always going to be different pricing for the different products. And heavier crudes trade, $10, $15 below the light crudes, simply because it costs more to process. Transportation is, you got to put condensate in with the heavy crudes to move it in the pipe down to the market. So I think that if we find more lighter crudes, then that would be better for the refineries. But the problem is the barrels are getting heavier everywhere, and so that really is the mix of oil product is heavier and heavier. We have Venezuela's crudes are heavy crudes. So if they come on with 2 or 3 million, that's heavy. If we bring on another million or two, that's mostly heavy. So the reality is wherever you're going around the world, the barrel in Saudi Arabia can get heavier, other places, Libya. And so you've got to figure out, where the new barrels are coming from and then where can they get to market. And that's really the argument here. And of course, price is going to be a big issue because the cost of development are very, very high and getting more expensive, which means, if the price of oil stays 63 years from now, we will have knocked down the inventories globally a lot because $60 doesn't incentivize people to spend money. If we get $80 or $90 oil, we probably will be self-sufficient and meet needs. And if we get to 100, 120, we'll start building up new productive capacity to meet the growing needs for the outlier years. And so it's a typical thing is we run out of oil and there's too short oil. We start spending money, bringing on more and more and more, and then all of a sudden we've got a glut. And then everybody finally realizes it, and then you have some economic slowdown, be it 08, 09, or be it 29, 30, 2020, COVID, and you can get slapped around pretty badly. So right now, what my approach to it is, when you have things trading at 20, 30 cents on the dollar versus what I think they're worth in a normal market, $80, $90 normal market, that's a time to buy. And when it's trading at $120 of its value, then it kind of tells you take profits or sell straight out. We're not going to be there for a number of years to the point where we're trading at excess valuation.
Understood. And of course, at some point, cheap is cheap enough. Before we started recording, Joseph, you mentioned that you also have some thoughts on uranium.
Yeah, I think, Canada has Cameco and NextGen and others, and Saskatchewan is a very big producer of uranium. I think if we get small modular reactors, SMR reactors built, first thing they have to design them, get them approved, get them go through all the political and environmental stuff. And people need to know that there's no problems with, somehow a crack in the facility can, release, uranium, which could be potentially deadly. So I think all of those hoops have to be filled. But once that happens, you may see data centers have their own SMRs. You may see utilities around the world say, look, we have natural gas or we have coal, but we need, a base load, and that base load can be the SMRs. You've seen Japan reverse their view on nuclear power. We've seen France, change their mind. Germany is thinking the same way. So the more friendliness to nuclear power, then uranium will be, will do very well. We've seen the uranium stocks have a great run in 2025. And I think Cameco doubled during the year. So I think that people should continue to keep an eye on uranium as part of their portfolio. So I tell people, you want to have exposure to oil, you want to have exposure to natural gas, you want to have exposure to the service industry, and so then pick your place where you want to be based on balance sheet, dividends, stock buybacks, whatever you need in your mix. And again, people who are younger will have a more higher tolerance for risk. People who are older, will have a higher need for income along the way. And energy stocks right now, you can find ones to fit each of the bills of the buyers.
Yeah, definitely sounds like this uranium thesis that you're outlining with these small modular reactors is a bit longer term. However, it also sounds like something that could drive significant demand in a very inelastic market.
Yeah, and right now I don't think there's enough uranium being produced to meet the current demand. So if SMRs take off, that just is a driver that really is going to push the need much, much higher. And again, I don't know how much exploration money is being spent on uranium. I don't think it's a lot. And so, gold, we're starting to see a lot more, exploration, be in Canada, be it in, Mexico, wherever. Silver, all around the world, people are spending more money in Australia, Canada, other places, United States. And so I think that, wherever, it's the old story, wherever you found gold or silver or oil before, keep on looking in the same space, because you're going to probably find it maybe deeper, might be more expensive to extract, but it's there. And I think that's what everybody looks for when they're looking at a story is, do they have, number one, the team? Do they have does the area they're looking have significant upside? And do they have the financial resources to make it happen?
Joseph, this conversation has been incredibly insightful. Is there anywhere else you would like to direct the viewers that are still with us?
No, I would say to them, find, products that give you both the macro view and also specific company view. And if anybody's interested in our macro view, they can go to our Substack at Ion Energy on Substack. The other choice is if they're interested in the Canadian basin and the names, we have companies that are, 30, 40 billion dollars companies, and we have companies that are $10 million market caps. So go to www.schachter, S-C-H-A-C-H-T-E-R, energyreport.ca. And because this is our first time, our marketing person arm twisted me and said, let's put a deal out for your listeners. And so they can just go to the website and then put in the code PGR 100, and they can have $100 off the normal subscription rate of $9.99 Canadian.
Josef Schachter, thank you so much for your insights and your time today. Tremendously appreciate it.
Well, I appreciate that very much. Thanks so much. It's good to be with you.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.